I used to think that market structure is only really useful to understand the bias, so the direction. So for example, if we create lower lows right there, that means we are likely going to keep continuing lower. Now don't get me wrong, it is exactly useful for your bias, but it's useful for so much more than that, because that tells you the next target. But on top of that, it also tells you the range that you are trading in. And that range tells you exactly where to take your next trade, where to take your entry. Those are all things that you will learn in this video in the market structure masterclass. So again, why is this market structure important? Why is it relevant? And what are we going to dive into? We're going to dive into the bias right there, but also understanding that it's much more useful than just the bias, because it also tells you the ranges. It tells you the next target. And it tells you the best range to take a trade in and exactly where to take a trade. So where most just talk about market structure is nice for an analysis, I really want to dive into how to profit from market structure, because at the end of the day, making a profit, that is the goal, right? Now, in order for us to understand how we can profit from it, we need to build a foundation. So if you don't know what market structure in general is, I'm going to explain it. If you are already more advanced as well, then this is a very good reminder, because this sets the foundation, because you really want to focus on intermediate highs and intermediate lows. The rest of market structure, I want you to forget for this video at least. Focus on intermediate highs and intermediate lows. Okay, what are those? Well, first we need to understand again, what does market structure consist of? So a quick reminder right here. If you didn't know it, then now you know. Market structure consists of swing lows and swing highs. So for example, right here, this is a swing low, it's a 3-candle pattern. So once that third candle closes right there and this wick at the bottom right there is sticking out, that is a swing low. Now, on the opposite ends, we also have a swing high right there. Same 3-candle pattern, it just sticks out at the top right there. So wick sticking out at the top right there. The third candle closes right there. So we have 1, 2 sticking out at the top. The second one, the third candle closes, that creates a swing high. Okay, nice. How can we use that? Now, if we take a look at this right here, this is where we're going to dive into ITL. This is an intermediate term low. That right there, that low is the intermediate term low. Now, you might realize that is of course just a swing low. So what makes it an intermediate term low? What does it tell us extra? Why is this relevant? All things we're going to dive into as well. But the reason why that is an intermediate term low is because higher towards the left of it, we have a swing low right there. Higher towards the right of it, we also have a swing low. So that swing low in the middle that is sticking out at the bottom is that intermediate term low. If we invert that and we talk about an ITH, which again stands for intermediate term high, then that right there, that one at the top is an ITH, an intermediate term high. It's that swing high right there that we have at the top. Why is that an intermediate term high? Just invert it, the exact opposite right there. We have a swing high that's lower to the left of it, and we have a swing high that's lower to the right of that. Middle swing high right there that's sticking out at the top. That makes this that intermediate term high. So if we take a quick look at the chart right here, then for example, this right here is an intermediate term high. This is an intermediate term low. Why is that? Again, for the intermediate term high, we have this swing high lower to the left of it and this one lower to the right of it, right? For this intermediate term low, we have this one higher to the left of it and we have this swing high higher to the right of it. This, for example, is also an intermediate term high right there, because we have this one lower to the left of it. So it's not directly, for example, you would imagine it might be here. No, it's right there. And this one is the lower one to the right of it. And then this, of course, is also a swing low right there, which is that intermediate term low, because we have a swing low higher to the right of it and a swing low higher to the left of it right there. Okay, so how are these intermediate highs and intermediate lows actually useful? What can they tell us? This is where we're going to dive into number 2, the bias, the direction. We're going to quickly dive into it because everything after, in my opinion, is a lot more exciting. Intermediate highs and intermediate lows can tell you the general direction. So if we want to be bullish and if we want to be bearish, or even if we are consolidating as well. I like to call these the outsiders of the market. They are the longest swings. So what I mean with the outsiders right there is something that we are going to dive into in just a second as well. Now, first, understanding a bullish market structure. So if we are bullish, if we are moving higher, what would that look like? Well, we are trading above intermediate highs and we don't trade below intermediate lows. So for example, right here, this is a lot more simple than it might seem right here. It's quite straightforward. Here we have an intermediate high right there. Here we have an intermediate low. You could actually make the argument right there. It's not an intermediate low just yet because we have that third candle that still needs to close in order for this to become a swing low right there. But intermediate low, intermediate high right there. Here we see we are trading above intermediate term highs, that one towards the left right there. And if we now create a retracement, then the next likely move is to also trade again above that intermediate term high right there, because we traded above the previous intermediate term high. This creates that bullish formation where we are essentially just moving higher. So the intermediate term lows that we have at that moment in time are essentially protected. We don't trade below the intermediate term lows. If we invert that, look at bearish market structure, it's the opposite, right? So we trade below intermediate term lows and we don't trade above intermediate term highs. So again, quite straightforward. We have that intermediate term low right there, that intermediate term high. We trade below the intermediate term lows. If we now create a larger retracement again right here, then we're not likely to trade above the intermediate term high, and we are likely to keep continuing lower to trade below the intermediate term low that we see right there again. So to show you what this would look like in the market is something along these lines. Now, this is where, again, I mentioned the outsiders of the market. So what I literally mean with outsiders, I quite literally mean that. As in, for example, the longest swings, this right here is an intermediate term high. This right here is an intermediate term low. Intermediate term low, intermediate term high right there. Now, what we can see is happening right there is that we keep trading below the intermediate term lows. Here we have another intermediate term low, intermediate term high right there, intermediate term low right there. So the formation that is essentially forming is something along these lines, right? Intermediate term high. Well, we actually have this smaller right there in between, and we continue lower, have this rejection right there, and we continue lower again. We don't trade back above the intermediate term highs. Now, for me, I'm not necessarily that picky about saying, for example, well, actually, we also trade above this intermediate term high right there. No, I like to take a look at it from an outsider perspective. So, for example, if you really zoom out, you see we have an intermediate term high, intermediate term low, intermediate term high, intermediate term low, intermediate term high right there, intermediate term low, intermediate term high, intermediate term low, intermediate term high, intermediate term low right there. Really the outsiders, without necessarily being super specific about, well, actually, there's no swing high, so actually there is no intermediate term high or intermediate term low, for example. Now, as to the reason why I like to view them as outsiders is because for me, those intermediate term highs, intermediate term lows right there, when we talk about bias, they just tell you a general direction. So you could make the argument right here, we are more bearish than we are bullish, at least at this moment in time. But it doesn't mean that we will just follow through on that immediately. The intermediate term highs, intermediate term lows will become really important the moment we start talking about the ranges in just a moment. So a quick framework. If we trade above intermediate term highs and we don't trade below intermediate term lows, we are bullish. If we trade below intermediate term lows and we don't trade above intermediate term highs, then we are bearish. Now, there's one option actually missing right here, and that is the consolidation. If we trade above intermediate term highs and we also trade below intermediate term lows, then we are consolidating, because that means we are not respecting any side. So for example, if you go into any of these consolidations right here, you will notice that we are trading above intermediate term highs. At the same time, we're also trading below intermediate term lows, and we keep trading above intermediate term highs again. So we're not respecting one side, if that makes sense. So we're trading above and below both sides. That means that we are simply creating a consolidation right there. And we get out of that consolidation the moment we actually stop doing that, right? So for example, here, we see this intermediate term high. We then trade below intermediate term lows right there. We start creating more intermediate term highs right there, more intermediate term lows. Eventually, we don't trade back above intermediate term highs right there, and we keep trading below intermediate term lows. And that continues to happen right there, where we keep trading below intermediate lows. That's when we are getting out of that consolidation. So we are now then bearish. Now, this is the general direction, the bias, but in my opinion, this is pretty boring and basic. Now, if you're a little bit more of a beginner, then this could be very exciting for you. But the reason why I say this is because this inherently doesn't really tell you when to get involved. It doesn't tell you, for example, where you should be taking a trade. It just tells you literally the general direction. So you might be a good analyst now, but you don't necessarily know how to trade just yet. Okay, so how are they actually useful? How can we actually profit from them? Well, this is where we get into the exciting part, because this is where we talk about ranges. Now, if you didn't already, you might want to have a notebook out for this one. Okay, so these intermediate term highs and intermediate term lows are like magnets, literally like magnets. They attract price. They are certain targets, so what we can move towards. So this is because there is a lot of liquidity. So there's liquidity above an intermediate term high, and there's liquidity below an intermediate term low. Now, liquidity, we understand those are just orders, right? So buy and sell orders. Now, exactly what that looks like, we're going to dive into in just a second. So what I want you to remember is, remember the magnet. So remember how these intermediate term highs and intermediate term lows are magnets. We can move towards them. but specifically a magnet. So I don't mean just a target, specifically a magnet. And the reason why I say that so specifically, again, something we're going to dive into, because a magnet, of course, acts a certain way. It attracts price a certain way. Okay, moving on. So magnets and liquidity. If we, for example, have this intermediate high right there that acts as a magnet, that's what we can move towards. That's our next target right there. Now, if we continue higher, eventually we will also have this intermediate high right there. That is also, again, a magnet. That's what we can move towards. It's that target, the next likely target right there. Now, once we reach that target, again, above an intermediate high like that, there's liquidity. That's also the reason why we move towards it in the first place. So it's not just a random magnet. No, there are orders there. So there are people willing to buy, but at the same time, there are also willing to sell, or those are unwilling sellers. So they just got trapped by the market, for example. Now, whether it's willingly or unwillingly, it is, at the end of the day, it is liquidity right there. And liquidity, that means when there are orders right there, usually what we tend to do is we tend to create somewhat of a rejection initially. Even if we want to continue higher afterwards, we tend to create somewhat of a rejection initially right there. And then after, we might even create somewhat of a consolidation. Now, the reason as to why that oftentimes is because we are matching those orders. So for example, you can imagine if we reach, let's say, a weekly or a daily intermediate high, there are a lot of orders. There are a lot of institutions, hedge funds, people trying to get involved at that moment in time, or they just got taken out of their trade. So we are consolidating because it might take us some time to actually start matching all the orders that are executed at that moment in time. So, and the reason why people are looking to buy and sell at that moment in time, well, a lot of times these market structure areas right there, they are used for stop loss placements, but at the same time, they're also to view, for example, the same buys what we talked about. As in, if we keep trading below these lows right there, even if they don't necessarily know it is an intermediate low, it still signals what? Well, because we are trading below lows, that signals that we are weaker. So for example, a lot of breakout traders at that moment in time are also looking to enter a trade like that in the hopes that we will keep continuing lower because we broke that low. So that might signal that the market is weak at that moment in time and we might continue lower. So there are essentially a couple of options as to what can happen when we reach that intermediate high or when we reach an intermediate low. We might, for example, continue higher afterwards, again, right there. Or we might just consolidate, or we might just continue lower. So there are inherently three options, right? There's in general three options at any time what the market can do. There are only three possibilities as to what the market can do in general. We can either move higher, so we can be bullish, or we can move lower, so we can be bearish, or we're not moving higher, nor are we moving lower. We are creating consolidation. At that moment in time, we're not going anywhere. So how do we figure out which option is next after reaching the intermediate high or reaching the intermediate low? Well, what if I told you that we don't really have to, do we? But let's just take a step back here. Because all we want to do is we want to just trade towards the magnet. So afterwards, we don't want to trade away from a magnet or, well, once the magnet is broken or something, then expect a consolidation and try to trade that. No. But if you just take a step back and you trade towards the magnet. So what does that look like? Well, for example, the same example right here. We have that magnet right there. But what if you don't trade after it? You just trade towards it. As simple as that. So this right here, that blue area is where you would want to look to get involved. If we now continue higher and we reach that, and once we reach that, we essentially wait, right? If you're still involved in the trade, perfect. You can potentially go break even, etc., and it might hit you to take profit eventually, but don't look for a new trade ID. Then here, for example, we also have this magnet, that intermediate high. Okay, we don't trade after we reach it. No, let's do it before. So that blue area, for example, right there, that's where we want to get involved right there. The last part towards that intermediate high or trading towards intermediate lows. Because after we reach that, there are, well, different possibilities as to what might happen. There are three options. Before we reach that, there really is only one option, right? And that is, well, the closer we get to the magnet, the more likely it is that we are just going to reach towards that magnet, towards that liquidity right there. So there really is only one significant option, and that is to continue higher, at least reach the target. After we reach it, there are many possibilities. And in general, the more possibilities you have, this is how trading works. You might want to write it down because it's quite important for your trading. The more possibilities you have, the lower the probability of one singular possibility. Think about it, right? If you have three different possibilities, three different options as to what the market might do next, then every option has 33% attached to it. If we have this right here, well, then you might say, well, this is actually 90, 80% that we are going to reach that high right there. So it's a lot higher probability because there's only a singular or maybe two choices, two options left. Okay, before we go any further, let's take a quick step back right here. Let's understand these ranges and what we are looking at right here before we also dive into the chart itself. You want to trade in between highs and lows. This is the most important part because that's where the highest probability moments, the highest probability trades are going to be present. You want to trade in between highs and lows at every single moment in time. So for example, right here, this is in between an intermediate low and in between an intermediate high where we are somewhat in the middle. We don't necessarily have to be exactly in the middle at all times, but here we see we are in between an intermediate high, in between an intermediate low. So between a high and low. We are now in that range. So that's your range. This is your range. So from the intermediate low right there towards the intermediate high is essentially your range right there. Why is that important? Because it's now just a matter of now trading towards the strongest magnet. So either towards the intermediate high or towards the intermediate low. So that means we can either continue higher towards the intermediate high or we can continue lower towards the intermediate low. So to fully drive this point home, what this looks like is the following. This is good, a check mark right here. This is good. This is the same example we just looked at right there. We are in between an intermediate low and in between an intermediate high. The next one is not good. So again, a cross right here. Why is this one not good? Because now we are trading above this intermediate high right there, above that high. Well, we do have that low, but we are above that intermediate high right there. So we are not in between a high and low anymore. We are above a high. So how does that turn good again? Again, the check mark right here. Well, for example, if we create a larger retracement again, because now we have this high again, and we have that low. So we are again in between an intermediate high and in between an intermediate low. This is important to understand. So what this looks like from a candlestick perspective is, well, the things we already went over. So for example, right here, we have an intermediate high right there, and we have an intermediate low. So this in itself is your whole range that you are working with. And now it's your job to figure out, are we trading towards the intermediate high or are we trading towards the intermediate low? Which magnet at that moment in time is stronger? So a bearish example of this is, again, the following. We have that intermediate high and we have this intermediate low right here. This is where we are now in that range again, right? So to show you what this looks like on the chart itself, for example, at this moment in time, right here, if we go back a little bit, we see that we have this intermediate high and we see that we have this intermediate low. This in itself is the range that we currently have. So you could argue, if you want to draw it with a box, if that might help you right there, this is the range that you're having. Now it's your job to figure out, are we trading towards the intermediate high or are we trading towards the intermediate low right there? Because those are those magnets, those are the next targets. This is your range. So the first thing you also want to do is when you open your chart is mark these out on your chart. So mark out intermediate highs and intermediate lows on your chart. And that is the range that you are working with. Now, of course, when you try to mark this out on your chart, also timeframes become arguably somewhat of an issue. What timeframes are you going to focus on? That's all things we're going to dive into, but that is a little bit later in this video as well. Okay, so where in the range do you get involved? Because it's fun that we have a range, but where in the range are you looking to buy? Where are you looking to sell? That's still quite vague. Now, then we need to understand which one is the stronger magnet. Because if we understand that, then we can understand where in the range we also want to buy or where we want to sell. So in order to understand that, we're moving on to number 4, the range to take a trade in. So exactly where we are going to look for a trade. Really quick before we move on, we apply all of this knowledge, all of these concepts every single day in MMT. And with the goal in mind to get funded, stay funded, and get payouts. And these frameworks help exactly with that. In MMT, we take it a step further with the frameworks. And again, like we mentioned, we apply it live with you. If that does sound like something that you could absolutely use help with, then for more information at the end of this video, you can head on over to the link in the description. But before we do that, let's first finish this video right here because we are not done just yet. So my question to you is, and this is literally my question to you, at which point is a magnet the strongest? It's not a trick question, I promise you. It's quite straightforward, right? So the closer we get to a magnet, the stronger it is. So let me give you this example. I have 2 magnets right here. Here I have a yellow one. This one represents price action, so the price itself. This blue one right here is liquidity, that intermediate high, intermediate low. Again, when we are very far away, so these magnets are very far away from each other, then inherently there's no strong pull towards it, right? But the closer we get to it right there, eventually it will want to snap towards it very fast right there. So the closer we get, the closer these magnets get to each other right there, the stronger the magnet gets. Why is that important to understand? Well, let me quickly sketch that idea for you on a chart. Because when you understand what the next likely move is, even if it's just in the short term. So if you understand this price action is going to snap onto that next target right there, if we are getting very close. Again, what is inherently a trade ID? A trade ID is not necessarily about always getting the target right or getting the whole analysis right. No, if you just look at it for what it is, then a trade ID, if I place this trade, for example, then all I'm looking for is that price will move in my favor before it moves against me. So moving in my favor, that it hits my take profit before it goes against me and might hit my stop loss. That's all a trade ID really is, right? So if we can understand where price is more likely, at least in the short term, to move in our favor instead of against us, so move very fast in our favor, then we can always profit from that. That will become more clear. How do we actually go ahead and do that right now? So to sketch you this idea right here. Here we have a magnet at the top right there. And we also, again, have that magnet at the bottom right there, right? But if we are in the middle right here, then we are not that close to neither magnet. So there's not a strong pull towards either magnet at that moment in time. So in the middle right there, this is where you ideally want to wait, where you don't really want to do anything at this moment in time, because it's more likely that you might get caught up in a consolidation. If we, for example, take a look at this price action, when we are in the middle of this intermediate low and that intermediate high, this is where we are more likely to somewhat consolidate. The closer we get towards either the intermediate low right there, or what we see right here, that's the faster we run towards it. And the more likely it is that we are indeed going to run towards it as well. So the red area right there is where we want to wait. Now, exactly what that specific area is, something we're going to dive into. Here, the orange area right here is ideally where you might be looking for the entry, but not necessarily looking to get involved just yet, just still waiting a little bit. That green area is where you want to buy right there. The same for the opposite side. So we have this intermediate low at the bottom right there, that magnet again. Okay, the red area is still something we want to wait right there. Then the orange area, okay, we might be start to look for the entry right there. And the green area right there is where we want to sell, to continue lower towards that target that we have, that magnet that we have. That's also oftentimes where we will move the fastest. So if you start marking out all intermediate highs and intermediate lows, then you will start noticing something right here. Because the moment when we are getting very close to reach an intermediate low, for example, right here, the moments just before it is where we move very fast. So for example, here, this intermediate low right there, before we reach it, we move very fast. Before we reach this intermediate low, we move very fast. The further away we are from it, the slower we also move. So again, think of it literally as a magnet. The closer we get to it, the faster or the more pull there is towards that magnet. So the faster it's also going to move towards it. Now, if you look at this scenario right here, then you might argue as well, of course, well, is then the whole general direction thing that we went over earlier on, is that not that relevant, or how does that work? Yes, it is relevant, because if you understand general direction and you then understand those ranges, then you understand, for example, if we are bearish at that moment of time, because that's the general direction, then trading, for example, in this range towards that intermediate low is inherently higher probability. That doesn't mean that you can't trade towards the intermediate high right there, but it does mean it is lower probability. But that also means right here that you do want to let go a little bit of that overall direction. So what I mean by that, for example, if you take a look at this scenario, then you might argue, well, here we look bearish, so we should be trading towards those lows, which that's not a bad thought process, not at all. But that doesn't mean that we can't trade towards these highs at all, for example. And I'm going to show you how that would work in just a second. Okay, but now the question is, of course, we understand the ranges somewhat. We understand where we somewhat should buy or sell, but it's still vague, right? So what is close enough? When do we get close enough to where we can actually buy or where we can actually sell? How can we objectify that a little bit more? Well, that is quite straightforward. So this same price action, it is essentially the last PD ray before an intermediate high, an intermediate low, or intermediate low. This is where I want to introduce a little bit the PD ray right there, but it will be quite smooth, I promise you. So right here, we see that we have that magnet right there. Then the last PD ray that we have before we might reach that intermediate high or that intermediate high is that bearish fair value gap right there. So if we disrespect that bearish fair value gap right there, we have that blue area right there where we want to get involved. Same, if we take a look at this intermediate low right there, the last PD ray that we have at that moment in time is this bullish fair value gap right there. So that's the last, essentially the last support area that we could potentially still continue higher from before we reach this intermediate low right there. So it's the last thing that could prevent us from reaching that intermediate low, if that makes sense. So this right here is that blue area as well. That is where we could potentially get involved the moment we disrespect that bullish fair value gap and we don't continue higher from it anymore. Okay, how does that make sense? What are we looking at right here? Which PDWs? First of all, again, quick reminder, it's the same, right? Those PDWs. So for example, swing low, swing high, those are also PDWs right there. So for example, the second PDWA that I tend to use is fair value gaps, or our fair value gaps right there. So also a 3-candle pattern is those gaps right there that we see in the middle. You might already understand that. And the third that I like to use is an order block right there. So the retracement, for example, before we continue higher, that's what I like to call an order block right there. Or what I also like to refer to as a fair value area. These are the PDWAs that I like to focus on right here. Now, what can these PDWAs do? Important to understand before we move on to back to the market structure. PDWAs can either respect or they can disrespect. So what does respecting a PDWA look like? When we trade into that PDWA, for example, that swing low, we're simply rejecting away from it. That means we are respecting it. If we are disrespecting it, that means we have that same PDWA, that swing low, for example. Instead of rejecting away from it, we are just essentially blasting through it. We are just continuing lower right there. So we are disrespecting it. So that's the thing that the PDWAs can do. We can either respect it or we can disrespect it right there. Respect versus disrespect. Respecting it means that we are rejecting and moving away from it. Disrespecting it means that we are essentially doing the opposite. It keeps trading through that level, so we are disrespecting it. All right, so how do we again then combine this with market structure? Well, let's take a look again at this scenario right here. So we draw out that intermediate high right there. We also understand that we have an intermediate low at the bottom. We see right here, if we are, for example, just focusing on that intermediate high right here, we see that we have this bearish fair value gap, which is essentially that PDWA, right? Which is something that we can still continue lower from. If we disrespect that right there, then the next likely move is towards that intermediate high, so that blue area right there. Now, in order for you to now get involved, you are essentially filtering out the retracements right here. So before we look at that, let's actually mark out a couple of these areas before we take a look at the entry right here. So what I really like to do is I personally like to look at this on the 1 hour time frame, and I like to take 15-minute entries. I'm more so of a day trader, and I like to do that on the futures market, so Nasdaq, ES, etc. Now, I'm going to show you different examples of what that also would look like on different time frames. But right here, we see that we have these outsiders, right? So we have that intermediate high right there, and we have this intermediate low right there as well. So at that moment in time, I do understand, of course, that we are more bearish right there. So if we are looking for shorts, if we're looking to sell right there, it is in general higher probability than if we are looking to buy at that moment in time. Now, what are the last PDWAs that we have right here that are preventing us essentially from either reaching the intermediate low or reaching the intermediate high? Well, for example, here we see that we have these swing highs right there. If we reach those swing highs right there, that's probably an interesting area to look to buy. If we are looking to sell, what is the last area? Well, for me, that is this fair value area right here. So this area is where I'm going to start looking for my entry, essentially right there. And that's also where I personally took a trade. So those are essentially the two areas where you can then look to get involved. And you're always trading what we call in the MMT, where you're trading the peak momentum at that moment in time. So it's very likely that we are going to run towards that next target. So based on that, you also want to understand what type of entry you want to take. But something we're going to dive into. Let me show you another example here. This was actually this week right here, where I also took a trade on a Monday right there. Now we have this. So if we go back a little bit, we at this moment in time have this scenario right here. So we have this intermediate high, and we also have this intermediate term low sitting right there. Okay, so we have that same range, right? So then the next step is identifying, okay, what are the last PDWAs before we reach those next intermediate highs or intermediate lows? So here you could say it's this swing high right there. You could actually make the argument, I wouldn't really mind that. If you say, it's this fair value gap, that's the most obvious one, because then you create a little bit of a larger area where you can also still take an entry. But you'll notice we never disrespect the fair value gap right there. So what is disrespecting that fair value gap? If we were to disrespect that fair value gap, here we create this rejection, right? So if we now keep trading above it, like this again, for example, that's the moment we disrespect it, where you can actually start looking for your entry to continue higher towards those next targets. But here we never disrespect it. So we just respect it because we trade back into it and we continue lower from it again, right there. What is the last PDWA that we have? Just this fair value gap right there. You could actually make the argument as well. Or block right there, or fair value area, so I like to call it. That's the last PDWA before we might reach those lows right there. This is also where I took a trade right there. We'll dive into both entries. So here, if we now trade into that right there, then if we disrespect that fair value gap right there, then that is the moment where we can now look to get involved right there to then target this next intermediate low, because that is the magnet. So this area right there, or it's this area right here. And really, it's a matter of which one are we going to reach. Again, it's also on top the understanding, yes, we have been more bearish, we have been moving lower, right? So the bearish, well, the sales, the shorts right there are inherently just higher probability. So to give you a current example of this on NASDAQ, where I'm personally looking to get involved, or where I would like to buy or sell, is we have this intermediate high right there, intermediate low. So that's your first step, identifying the intermediate highs and intermediate lows right there. Now, on which time frame you want to do that? Again, something we're going to dive into in just a bit. Then identify the last PDA we have before we reach those. So that, for me, before we reach those highs, is this fair value gap right there. If we reach these lows, that is this fair value gap right there. So anything that happens in the middle right here, from my perspective as a day trader, is not necessarily that interesting. Doesn't mean it's not interesting for a scalper, for example. But from a day trading perspective right there, that's not necessarily that interesting. So day trading perspective, I mainly refer to, I'm using 15-minute time frame entries. So this is where I'm waiting, either we disrespect that one to continue lower, or disrespect that one to continue higher right there. That's what I'm waiting for. Then what are you going to look for an entry? Now, the entry you are looking at is essentially you are filtering out the retracement. So what is important to understand? Again, when you have that intermediate high right there at the top, literally think of it as a magnet. So the closer we get to it, the faster price action is also going to move towards it, most likely. And if that's not the case, then your risk management should adjust, also something we're going to dive into. But the closer we get to it, the faster we should run towards it, if that makes sense. Because it's literally like a magnet. So you're just essentially filtering out the retracement. The moment we can't, or you think we can't retrace anymore right there, that's the moment you want to get involved. I'm going to explain how I view that. I'm going to do that through the two trades that I took right here. So we see that we have this intermediate high and that intermediate low right there. Now, at that moment in time, of course, well, right here, we see that we are reaching this bullish fair value gap instead. So I like to look at this on the 1 hour time frame. Then on the 50-minute time frame, I like to take my entries. So here we see that we now create this larger rejection. So I like to identify what is the rejection from, for example, that bullish fair value gap right there. For me, it's that low at that moment in time. That is where we created a little bit of an up move right there, that rejection. Again, all I'm doing at this moment in time is I'm trying to filter out the retracement. Why am I doing that? Because literally, like I just mentioned, a trade ID is just price action moving in your favor just a little bit right there before it might go against you. That's it. So if I can understand we are not going to retrace anymore, then I can understand if we're not retracing, well, what is the only likely thing that we are going to do is just drop off, right? So I like to mark out the rejection right there from that fair value gap on the 50-minute time frame to see if we are still respecting it or disrespecting it. If we trade below that rejection right there, like we see right here, then what I'm looking at is from that low, if we can get a formation like this. So somewhat of a retracement to then continue lower again. So here, for example, what we see is we create that wick. And again, what is happening right there is we sting below it. That wick does something like this, right? It was first up candle and then it came all the way down right there. So that to me tells me right here that the momentum is very bearish and that we are likely going to continue lower. So the moment we reach below this low right there, that is also the moment where we now continue lower, just drop off heavily towards that next target. Now, if you think, Arjo, this is nice and all, but it wouldn't be that quite difficult to spot in real time. No, I will actually put a link in the description so you can also head on over to, you can join the newsletter and you can head on over to see this trade where I literally took this live trade. So that eventually is where we then drop off heavily in the next candle right there. And we reach that target quite fast right there. Now, the same, for example, if we go back a little bit right here, we again have this situation, right? If we zoom out a little bit, we have the 1 hour intermediate high right there at the top. And we also have the intermediate low right there. Now we continue lower as we see, of course. We see that we have this last order block fair value area, as I like to call it, before we reach those lows. Now, you might think, Arjo, well, isn't it this swing low right there? And you are correct in saying that. That is actually the last PD area right there. The reason why I might take, for example, the fair value gap or the order block or fair value area a little bit before that is if this area is, for example, very small right there, and I take a 15-minute entry, oftentimes an entry will not be present for me. So the fair value area, the fair value gap, again, the OR block that's just before it right there is oftentimes the better one to pick, because that creates a little bit of a larger area right there where I can still comfortably get involved on the 50-minute, and I can still target the next target with a 1 to 2 RR, etc., etc. So if we take a look at this scenario right here, simulate this down candle right here, then on the 15 minutes right there, we see that we have this larger rejection. Okay, perfect. So we again have the rejection. Again, all I'm doing right now is just filtering out, can we still retrace or are we just going to continue lower? Here we see the retracement right here, and we continue lower again. So what I now want to see from this low is the same thing that I just wanted to see, is something along these lines right here. So here we see that we have this next candle create somewhat of a long wick at the bottom and also this long wick at the top right there. So what we have at that moment in time is a scenario like this, something along these lines right here. It's not entirely clear if we can continue higher immediately or continue lower right there. Okay, so the next candle is very clear for me, because now what happens is we continue lower right there. We create that wick at the top right there. So exactly what I want to see, and we drop off again. Similar pattern to what we just saw before. So below this low right there, that is where my entry is right there, covering the bodies right there, targeting a 1 to 2 RR. That is where my entry was right here to continue lower. And the area is big enough right there to still comfortably target a 1 to 2 RR. Once we reach the target again, once we reach the magnet, that is where we can now potentially consolidate. It's not that clear anymore. So what I need you to understand as well is that for your risk management, you can go break even fast, because price should be fast. Again, in these areas, those last areas, because this is again that magnet, price should move fast towards it. Now, fast is of course all relative, because on the 50-minute, you could argue, well, this still took, what is that? 45 minutes right there. So it's inherently not that fast, but relatively seen on the time frame that you are looking at on your entry time frame, price should ideally be moving fast towards the next target right there, because that's the nature of the area that you are trading. So that also means that you can go break even quite fast. For example, if we create this fair value gap right here, then I'm not waiting for that fair value gap to be created and we might retrade back into it, might create a large trade like this and then continue lower. No, price should reach this fast. And once it reaches this, after that, it can actually create a larger retracement. So for example, in this scenario where my entry is along these lines right here, covering those highs right there, and my 1 to 2 RR has not been hit just yet, but we have reached the target. This is also where I now want to go break even, because now the only reason why it might create a large retracement is just to take me out of the trade, if that makes sense. So we should just move fast towards take profit right there. So once we have reached this target, for example, right here, what do you actually do now? What are you waiting for? Well, you're just waiting for us to trade in between highs and lows again. So for example, these were the previous highs and lows right here. Let's replay a little bit. And at this moment in time, once we've reached that low, this is where I don't necessarily want to get involved anymore. Because now, yes, we could still be dropping off right there, but it's not that clear anymore. Again, there are multiple possibilities as to what can happen. If we now create a retracement like this right here, here we are now in between still this high, that doesn't really change, but we still have, or we now have this intermediate low as well. So we're now trading in between this high and this low. So you would do the same thing. So for example, right here, if you mark out this high right there, if you mark out this fair value gap right there, now here we actually continue higher, spoiler alert. And with this last area, that is where you can actually get involved again. This is also, again, what we broke down live during a live session in MMT, where we were talking about this scenario right here. Same thing, what we're looking at for that entry right there. And we're seeing the large rejection right there from this rejection that we have right there. And then the next candle continues higher right there, the buy above this candles right here. And a couple of MMT members also called this exact trade. Now, the next thing we should understand, those are time frames. We should understand time frames. Those are very important to understand, because this, for example, this scenario right here could be on the daily time frame, could also be on the 50-minute time frame, could be on a 1-minute time frame. Again, I didn't specifically mention those time frames before right here. So if you just look at the candlesticks right here, this is all fractal, which means it happens on the monthly, the weekly, every single time frame you can imagine, which is good news, because that means you can apply this if you are a swing trader, if you are a day trader like me, or if you are scalping, which we also do a lot in the MMT. We scalp, we flow traders, we call it, which is where we, for example, apply this on the 1-minute time frame. So what I need you to understand is that intermediate highs and intermediate lows, they're everywhere, because it just depends on which time frame you are looking at. So it really depends which intermediate highs, intermediate lows you are going to focus on. Depends on the type of trader that you want to be. And let me explain this a little bit more clearly throughout the chart. So what I think is important to understand, even if you're going to dive into the 1 minute time frame eventually, then you still want to understand what are the intermediate highs, intermediate lows on these higher time frames. So for example, at first I might mark this out on the 4-hour time frame right there. And what you're going to do is you're essentially going to go deeper and deeper into price action if you're, for example, a scalper. Again, if you are a swing trader, you could just say, well, for example, right here, you have this 4-hour last fair value gap. If we get the entry, which presents itself right there, then you can even use the 4-hour to just enter right there to then continue lower, right? So that would be quite straightforward. But the more difficult part is if you're a flow trader right here, or if you're a scalper. Once we reach this intermediate low right there, you want to wait again. Now, what you might do is you might go into the 1-hour time frame, for example, right here, where you now also identify, well, we also have this intermediate high and we also have this intermediate low right there. Now, this is not where we want to stop on the 1 hour, because going from the 1 hour to then take a 1 minute entry, it's quite a big jump, if that makes sense. I'm not necessarily a big fan of that. So what you might do is you might go into the 50-minute time frame, but the reason why the 1 hour is still relevant, is still important, because you can still understand, for example, if we are, the general direction is more bearish right here, we have just reached an intermediate low right there. If we are now, for example, disrespecting this bullish fair value gap right there as well, we are running these lows right here, then it is likely that we keep continuing lower towards those lows. Again, why are we not playing this move right here to continue higher towards that high, for example? Well, the reason why that is again, if you want a higher probability trade, follow along with the general direction that you have at that moment in time. But this, understanding that on the 1 hour, that we're more likely to continue lower, etc., is important. So we might dive into the 50-minute time frame right here. Now, what do we do on the 50-minute time frame? Well, on the 50-minute time frame, this picture becomes a little bit more clear. So for example, here you have these last lows right there before we reach those last lows. That's where you, for example, can really dive into the 1 minute time frame where you have really refined it. Now, you can even do it a little bit before that. So for example, let's take it a little bit of a step further. We understand that we are moving lower right here. Then what you might do is, for example, on the 1 minute right here. And again, this is where if you're diving into the 1 minute, I do feel like it's very important to tell you that you should understand the general direction of what we are looking at, etc., etc. Because if you don't understand that, it becomes quite difficult and you get tricked into the market very easy. So for example, understanding that we are more bearish at that moment in time, general direction, then here on the 1 minute, you can see similar things, right? We are running towards those lows, and that creates this domino effect. So where we are eventually running towards all these lows right here. Another example that might make it a little bit more clear right here is, for example, on the 1 hour, we see that we are dropping off towards those lows. This is also that area where I took a trade. During a live session in MMT as well, we discussed this a little bit earlier right there. So if you, for example, go into the 5 minute, because you might be a scalper, then you see you also have this intermediate low, that next target right there. At the same time, you also have, well, eventually you have this target right there, the intermediate low. That's important. So here we see we have this last low right there before we start reaching into that intermediate low, which is all part of the larger direction that we are looking at to continue lower, right, towards those lows. So if we now, from this low right there, go into the 1 minute time frame, then here we see that similar thing. We see, again, we have the rejection right there. So we see this is the pattern I'm looking for. We have this rejection right there, climb back above it. That essentially keeps happening right there. To then continue lower, targeting those lows. And that is exactly, again, where people got involved in MMT as well, and what we mentioned during the live session right there. This is how you would refine it to certain time frames. So for example, if you're a scalper, you might say, well, I'm going to use 15 minutes, 5 minutes, intermediate highs and intermediate lows right there, and then I'm getting involved on the 1 minute. If you're a day trader, you might say, well, I'm using the entry 15 minutes. I might look at 1 hour intermediate highs, intermediate lows. And for a swing trader, again, you might say, well, daily intermediate highs, intermediate lows, and I might get involved on the 4 hour or even 4 hour intermediate lows, intermediate highs, and I'm getting involved on the 4 hour or the 1 hour. If videos like these generally help you, then I can promise you one thing, the free newsletter will help you so much more. It's where I will send you, for example, that live trade as well that we were talking about a little bit earlier. And on top of that, you will get a whole lot more unique insights on how to actually apply this stuff as well. All right, perfect. Thank you.